if you've been exploring high yield income ETFs, you've of course come across ULTY, the YieldMax Ultra Option Income Strategy ETF, and with yields exceeding 70% distribution rate, it's no wonder some investors are asking, can you actually retire earlier using ULTY? In today's video, we're going to break down what retiring on ULT could look like, the pros, cons, and the real risks, and who this approach is and isn't for. So just a quick recap on ULTY. It's an actively managed ETF, meaning you're going to have a fund manager managing the portfolio, doing all the option trades for you. In return, it's going to be a 1.3% expense ratio, which is a bit high, but for the fund's performance, it's been exceptionally doing well. And this ETF, it holds underlying stocks. If we take a look at its holdings, it does hold the shares versus back then, before the strategy change, it was purely synthetic exposures. And this is going to help with that NAV stability, which everyone has been looking for with this ETF. And of course, to generate that massive income, it sells covered calls as well as credit call spreads against these underlying holdings to generate option income. And if we take a look at the holdings, a lot of these are going to be very volatile stocks. We have Robinhood, Upstart, and Reddit as some of the top holdings. And that is because the more volatile these underlying stocks are, the more income we're going to be making from option premiums. And then, of course, as part of the strategy change, it does buy protected puts to help limit the downside. And the main draw to this ETF is the weekly payout frequency, making it feel more like a paycheck ETF. Getting paid every single Friday feels very nice. Now, why are people choosing to retire with ULTY? Well, first one, of course, is going to be that massive yield. 70 to 80% distribution rate has been fairly consistent at the $6 price point. And unlike traditional monthly dividend ETFs, ULT pays every single Friday. And this regular payout can feel similar to a paycheck, as we mentioned earlier, which is going to help retirees budget their expenses. And as we mentioned, as part of the strategy change, it has been relatively stable ever since it went to that weekly change. And this reassures investors worried about the capital erosion. And the best thing about ULT is no options trading experience is needed. You just simply buy and hold this ETF. It's a very cheap ETF as well at $6 per share. A lot of people are buying this in different accounts. You could either buy it in a traditional brokerage, a taxable brokerage, or you could do it in a Roth IRA, where it's going to have that income, all those option premiums, tax-free. But for most people, a taxable brokerage is going to be the place where you want to buy ULTY, especially those younger who are looking to retire early. Because if you do have it in a Roth IRA, you are going to be limited to how much you can contribute to the IRA, as well as you can't withdraw your full money before age 59 and a half. That is a huge factor. So for me, my personal strategy is holding ULTY in a traditional taxable brokerage, while in my Roth IRA, I'm holding some heavy growth funds to help compound until 59 and a half. Let's see what an example retirement allocation could look like with different amounts. So say we have $10,000, $50,000, $100,000, $250,000, and $500,000. Now, of course, we could plug in some different amounts, but we're just going to get started with just 5 examples here. Now, $10,000, most people have this amount of money in their portfolio, which is going to be 1,600 shares approximately, and your weekly income is going to be about $153. Now, this is all based off of its last distribution, which is going to be 0.95, so 9 cents per share. And that's what we're using for this formula. As we can see here, 0.095. And then for the monthly, that's of course going to be $612 annual income. We multiply the weeks by 52, going to give us just under $8,000 per year. Not that bad for a $10,000 investment. And keep in mind, this is without any dividends reinvesting. And we're just assuming a 9.5 cents per share going forward. So $50,000, you're going to get 8,000 shares. Weekly income is going to come out to $766. Monthly income, this is where it gets pretty good. This is going to start paying some of your bills, paying your rent. $3,000, just over $3,000. Annual income, just shy of $40,000. So pretty good annual income. This is a great starting position to where you can see it can help cover some of your monthly expenses. But here's where the sweet spot, in my opinion, is. $100,000 is going to give you just over 16,000 shares. And this is all assuming a current share price of about $6.20. Weekly income, you're going to get $1,500 every single week. Now, this is a pretty big amount coming from dividends. And we do want to keep in mind these are distributions, not dividends, but we're just calling them dividends just for semantics because they do differ for tax purposes. Monthly income, $6,000. And then annual income, just under $80,000. Now, this is a sweet spot, in my opinion, because this is really where the annual average median income in the United States is about $70,000 to $80,000. And that's going to be pretty good for most people. But let's keep going on with $250,000, 40,000 shares, just under $4,000 per week. Monthly income, you're going to hit $15,000 every single month. And then you get into the six-figure range, $200,000 every single year from a $250,000 investment. Now, a lot of people do not have this type of capital in their portfolio, but if you just keep growing your portfolio, compounding, reinvesting dividends, eventually you can get to this amount, especially if you take on some side gigs, such as doing food delivery, doing thrift shopping and reselling. There's a lot of ways to make money, and especially online, you can even start on some online businesses. That would help bring in some more income, and then you can invest it more into your portfolio. Let's go to $500,000, which is going to give you 80,000 shares. Weekly income, $7,661. Monthly income, $30,000. And we're going to get some insane annual income, $400,000. And this is really where a lot of people would feel comfortable bringing in that kind of money, because we don't also know how reliable this is going to be in the future. So far, it has been very consistent between 8 cents at its lowest to 10 cents per share. On average, it's paying about 9 cents per share, which is very, very good. And seeing how consistent the dividends are every single week. But we also do have to note this is a relatively new fund, and we don't know long-term how it's going to perform, especially since we have been in a pretty bull market this past few months. So that's really where the NAV has stabilized and done pretty well. So for most people, $500,000 is going to be quite excessive, but you do want to have quite a big buffer in case things do go south. But once you start reaching the $100,000 mark, getting 16,000 shares, bringing in that annual income of $80,000, you're going to start seeing it pay for some of your living expenses. This could be your rent, your food bills, gas bills. If you do have any money left over from these dividends, you could just simply reinvest it and help grow it every single week. Now let's go over some of the biggest risks of retiring on ULT. As you mentioned earlier, very new ETF, especially since it just underwent a strategy change. It can change in the future. We don't know how this fund is going to be holding up 10, 20 years in the future. So we do have to take it with some caution. And if the ETF does end up going downwards, we could see some lower dividend amounts, especially if the volatility in the market goes down. That means we're going to be collecting less from option premiums. That's going to mean less dividend yield. But of course, it's an actively managed ETF, and hopefully they continue to choose very volatile stocks and underlyings in its portfolio to capitalize on high volatility Even when the overall market is not very volatile, there's always going to be some of those volatile stocks, and that's what this ETF is really going to have in mind. But going back to the spreadsheet, for me to retire personally on ULTY, I would like to see the annual income from this ETF pretty much be double, probably even triple my current salary from my job, which is around $90,000. And that's going to allow me to have that buffer. Of course, you have to pay taxes on these dividends, just as you would any normal job. But also having that triple your salary is going to give you that buffer in case the dividend yield goes down, as well as paying for unexpected expenses. With an employer, you do get cheaper healthcare, you get those retirement benefits, and if you're planning to retire on these ETFs, you're going to have to pay for healthcare out of your own pocket, which can be very expensive. So if you made, say, $50,000 a year, you could not really retire on $50,000 annual income from this ETF, because it's just going to be more expensive than if you were under an employer. That's not really something that people talk about. You do need, when you retire, you do need more income than you were actually bringing in from a 9-to-5 job. Now, another thing we want to note is you don't want to put your entire portfolio into this ETF. While it's great, while it's been paying out consistently, you still want to diversify from YieldMax. Say the company goes under, or they just end up quitting one day, that's going to take a big hit to your portfolio. So you want to combine it with some other stocks, some other ETFs, balance out your portfolio. You can actually click the link right here, the best 2 ETFs to pair with ULTY for a balanced income and growth portfolio. Now, so who might retiring on ULTY be right for? This is going to be best for investors who are comfortable with risk and income variability and understand how options-based strategies work, as well as investors who have other assets to draw from during bad months. It's also good for retirees who want a higher cash flow than bonds or traditional dividends can provide, such as from SCHD, which has a pretty low dividend rate of 4%. And they're okay with constantly monitoring the distributions and NAV regularly just because of the nature of these funds. And you want to use it as a portion of a diversified retirement income plan. And so people who should avoid retiring off ULTY are those who need guaranteed income and can't tolerate volatility in account balances, as well as those who prefer simple and predictable dividends, such as from SCHD. But I'm also a big fan of the ones from SPY and QQQI from the NEOS funds, which have a pretty high dividend yield of 14% paying out monthly and has been pretty consistent and stable. In order to make retiring on ULTY safer, there's strategies you can do to put into place, which is diversifying your income sources. You can pair it with funds, as you mentioned earlier. We have that video, you can check it out, as well as maintaining a cash buffer. Keep 6 to 12 months of expenses in cash or near cash, a high yield savings, or even park it in one of my favorite ETFs as a cash alternative, SGOV, which gives you a much higher dividend yield rate than a traditional high yield savings, which is paying under 4%. And if you're able to, and your annual income is very high from dividends, make sure you consider reinvesting part of those payouts back into some of these ETFs so you can continue to grow your positions and make sure you have a steady cash flow. Because that's what this ETF is all about. It's all about the cash flow. It's all about receiving your consistent dividends, and it has the potential for very high income. If you enjoyed this deep dive into ULTY ETF, subscribe for more ETF and retirement strategy videos, as well as options strategies as well. Comment below, would you ever consider retiring off of ULTY, and at what price point, and how many shares do you need for you personally to retire off of this ETF?